Question 1. Which of the following statements is true regarding a call option? A. It gives the holder the obligation to buy the underlying security. B. It gives the holder the right to sell the underlying security. C. It gives the writer the right to buy the underlying security. D. It gives the holder the right to buy the underlying security. Answer: D. It gives the holder the right to buy the underlying security. A call option provides the holder, the buyer, the right, but not the obligation, to purchase the underlying security at a specified price, the strike price, on or before a specific expiration date. This option is valuable if the underlying security's price increases above the strike price, allowing the holder to buy it for less than its market value. The writer, seller, of the call option, conversely, has the obligation to sell the underlying security if the holder exercises their right. Think of call as the right to call away the shares from someone. Question 2. An investor holds 100 shares of XYZ stock and sells one XYZ 50 call option contract with a premium of 300. C. The value of the underlying stock less the premium. D. The strike price, $50. Answer: C. The value of the underlying stock less the premium. This scenario describes a covered call, where an investor sells a call option while owning the underlying stock. The maximum potential loss occurs if the price of the underlying stock declines to zero. In this case, the investor loses the entire value of the 100 shares, but this loss is offset by the premium received from selling the call option. For example, if the stock was purchased at $6,000 total and the premium received was $300, the maximum loss would be $5,700 if the stock became worthless. Therefore, the loss is limited to the initial cost of the stock minus the premium received. Question 3. Under a non-discretionary account, a registered representative may decide which of the following without client approval. A. The security to be bought or sold. B. The amount of the security to be bought or sold. C. The time and price at which a trade is executed. D. Whether to proceed with a trade recommended by the representative. Answer: C. The time and price at which a trade is executed. In a non-discretionary account, the client must approve all key aspects of a trade, specifically the asset, what to buy/sell, and the amount, how much. The registered representative, however, is generally permitted to determine the time and price of execution for an order without explicit client authorization for each individual trade. This limited authority is sometimes referred to as time and price discretion and is considered an incidental part of handling client orders. For any other decision, the client's explicit permission is required. Question 4. An investor in a high tax bracket is seeking a fixed income investment that offers a federally tax-exempt income stream. Which of the following would be the most suitable recommendation? A. Treasury bonds. B. Corporate bonds. C. Municipal bonds. D. Agency bonds. Answer: C. Municipal bonds. Municipal bonds, often called munis, are debt securities issued by state and local governments and their agencies to finance public projects. A key characteristic of municipal bonds is that the interest income they generate is typically exempt from federal income taxes, and often from state and local taxes, as well if the investor resides in the issuing municipality. This tax-exempt status makes them particularly attractive to investors in high tax brackets who want to maximize their after-tax income. Always remember that munis typically mean tax-exempt income. Question 5. Which of the following types of investment companies issues a fixed number of shares that trade on the secondary market, often at a premium or discount to their net asset value, NAV? A. Mutual funds. B. Unit investment trusts, UITs. C. Exchange-traded funds, ETFs. D. Closed-end management companies. Answer: D. Closed-end management companies. Closed-end management companies, unlike mutual funds, issue a fixed number of shares only once during their initial public offering, IPO. After the IPO, these shares trade on stock exchanges, much like common stock, and their market price is determined by supply and demand, often fluctuating above premium or below discount, their net asset value, NAV. Mutual funds, by contrast, are open-end funds that continuously issue and redeem shares at their NAV, while ETFs also trade on exchanges but are typically priced very close to their NAV due to a unique creation/redemption mechanism. Question 6. Under FINRA Rule 4210, what is the minimum equity an investor must deposit if the initial purchase in a margin account is $3,000? A. $1,000. B. $2,000. C. $3,000. D. $1,500. Answer: B. $2,000. For initial margin account purchases, FINRA Rule 4210 dictates specific minimum equity requirements. If the purchase amount is less than $2,000, the full purchase price must be deposited. If the purchase amount is between $2,000 and $4,000, the minimum deposit is $2,000. If the purchase amount is over $4,000, the initial deposit requirement is 50% of the purchase price, as per Regulation T, or $2,000, whichever is greater. Since $3,000 is between $2,000 and $4,000, the minimum required deposit is $2,000. Question 7. All of the following are typically characteristics of common stock XCPD. A. Preemptive rights. B. Voting rights. C. Fixed dividend payments. D. Residual claim on assets in liquidation. Answer: C. Fixed dividend payments. Common stock represents ownership in a company and typically carries voting rights, allowing shareholders to elect the board of directors and vote on corporate policy. Common stockholders also have preemptive rights, which allow them to maintain their proportionate ownership by purchasing new shares issued by the company. In liquidation, common stockholders have a residual claim on assets, meaning they are paid last after all creditors and preferred stockholders. However, common stock dividends are typically variable, declared by the board of directors, and are not fixed or guaranteed, unlike preferred stock dividends, which are usually fixed. Question 8. A bond quoted at 102.50 is trading at A. A discount. B. Par. C. A premium. D. Face value. Answer: C. A premium. Bond quotes are expressed as a percentage of their par, face, value, which is typically $1,000. A quote of 102.50 means the bond is trading at 102.50% of its par value. Therefore, 102.50% of $1,000 is $1,025. Since this price is above the $1,000 par value, the bond is trading at a premium. A bond trading below 100 is at a discount, and a bond trading exactly at 100 is at par. Remember, anything above 100 is a premium, below 100 is a discount. Question 9. An investor expects a significant decline in the price of XYZ stock from its current market price of $70 per share. To profit from this expectation, which of the following strategies would be most appropriate? A. Buy XYZ call options. B. Sell XYZ put options. C. Buy XYZ put options. D. Sell XYZ stock short and buy XYZ call options. Answer: C. Buy XYZ put options. An investor who expects a significant decline in a stock's price is said to have a bearish outlook. Buying a put option gives the holder the right to sell the underlying stock at a specified strike price. If the stock's market price falls below the strike price, the put option becomes profitable because the holder can sell the stock at the higher strike price. Through exercising the put, even though its market value is lower, This strategy directly benefits from a decrease in the underlying asset's price, making it ideal for a bearish investor. Question 10. Which of the following is a key characteristic of a Roth IRA? A. Contributions are tax deductible. B. Qualified withdrawals are tax-free in retirement. C. Required minimum distributions, RMDs, must begin at age 73. D. Contributions are limited to earned income and income limits apply. Answer B. Qualified withdrawals are tax-free in retirement. A key benefit of a Roth IRA is that contributions are made with after-tax dollars, meaning they are not tax-deductible in the year they are made. However, once certain conditions are met, the account has been open for at least 5 years, and the individual is age 59 and a half or older, disabled, or deceased. All qualified withdrawals from a Roth IRA, including earnings, are completely tax-free. Unlike traditional IRAs, Roth IRAs do not have required minimum distributions, RMDs, during the original owner's lifetime. Remember, Roth equals retirement is tax-free. Question 11. Which of the following types of preferred stock allows investors to receive skipped dividends if the company resumes dividend payments? A. Callable preferred. B. Convertible preferred. C. Cumulative preferred. D. Participating preferred. Answer C. Cumulative preferred. Cumulative preferred stock includes a provision that requires a company to pay all skipped or unpaid dividends in arrears, to cumulative preferred shareholders before it can pay any dividends to common stockholders. This feature provides a measure of security to preferred shareholders, as they are accumulating their right to payments. Other types of preferred stock, such as callable, convertible, or participating, offer different benefits or features, but do not specifically address missed dividend payments in this manner. Question 12. Which of the following actions by a registered representative would require written authorization from the customer for each trade? A. Recommending a specific security to a customer. B. Deciding the time and price of execution for a customer's order. C. Entering an order for a customer without consulting them regarding the security or amount. D. Sending a customer a research report about a company. Answer C. Entering an order for a customer without consulting them regarding the security or amount. Entering an order for a customer without consulting them about the security, what to buy/sell, or the amount, how much, means the representative is exercising discretion over the account. To do so, the customer must have granted written discretionary authority to the registered representative, and the account must be formally designated as a discretionary account. Without this written authorization, each trade where discretion is exercised over asset or amount would be considered unauthorized and a violation. Deciding only the time and price of execution does not require discretionary authority. Question 13. Which of the following is a characteristic of Treasury bills, T-bills? A. They pay interest semi-annually. B. They are issued at a discount to par value. C. They have maturities of 2 to 10 years. D. Their interest is subject to state and local taxes. Answer B. They are issued at a discount to par value. Treasury bills, T-bills, are short-term debt instruments of the U.S. government, typically with maturities of 4, 8, 13, 17, 26, or 52 weeks. Unlike Treasury notes and bonds, T-bills do not pay periodic interest. Instead, they are issued at a discount from their face value and mature at par, with the difference representing the investor's interest. The income earned on T-bills is subject to federal income tax, but is exempt from state and local taxes. Question 14. What is the primary purpose of a Chinese wall within a broker-dealer? A. To separate investment banking from retail brokerage operations. B. To prevent the spread of material non-public information between departments. C. To protect client assets from unauthorized access. D. To manage the flow of funds between firm accounts. Answer. B. To prevent the spread of material non-public information between departments. A Chinese wall is an ethical barrier within a financial institution designed to prevent the flow of material non-public information. MNPI. Between departments that might have a conflict of interest, such as investment banking, which might possess confidential information about a merger, and trading or research departments. Its primary purpose is to stop insider trading and other misuses of confidential information, ensuring that one department does not use information gained from another department to gain an unfair trading advantage or share it improperly. It's a critical compliance measure to uphold market integrity. Question 15. All of the following are potential risks associated with investing in exchange-traded notes, ETNs, except A. Credit risk. B. Market risk. C. Liquidity risk. D. Active management risk. Answer. D. Active management risk. Exchange-traded notes, ETNs, are unsecured debt securities that track an underlying index of securities. As debt instruments, they carry credit risk, meaning the issuer's ability to pay interest and principal is a concern. They also have market risk, as their value fluctuates with the underlying index, and liquidity risk, as they may be difficult to sell quickly in certain market conditions. However, ETNs do not involve active management risk because they are structured to track an index, rather than relying on a portfolio manager's discretion to pick securities. Their performance is passive, tied directly to the index they follow. Question 16. What is the main distinction between an American depository receipt, ADR, and a direct investment in a foreign stock? A. ADRs are denominated in the foreign currency, while foreign stocks are in USD. B. ADRs represent ownership in a foreign company's shares but trade in US dollars on US exchanges. C. ADRs pay dividends in the foreign currency, while foreign stocks pay in USD. D. ADRs are directly issued by the foreign company, while foreign stocks are issued by a US bank. Answer. B. ADRs represent ownership in a foreign company's shares but trade in US dollars on US exchanges. American depository receipts, ADRs, are certificates issued by a US bank that represent a specified number of shares of a foreign stock. Their main distinction is that they allow US investors to buy and sell shares of foreign companies on US exchanges denominated in US dollars without having to deal with foreign exchanges or currencies directly. While dividends are paid in the foreign currency, the depository bank converts them to US dollars for the ADR holder. This simplifies international investing for domestic investors by making foreign stocks more accessible. Question 17. A registered representative is discussing investment options with a client who is concerned about inflation eroding the purchasing power of their fixed income portfolio. Which of the following would be the most appropriate recommendation? A. U.S. Treasury bonds. B. Certificates of deposit, CDs. C. Treasury inflation-protected securities, TIPS. D. Municipal bonds. Answer. C. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are U.S. Treasury bonds designed specifically to protect investors from inflation. The principal value of a TIPS bond adjusts semi-annually based on changes in the Consumer Price Index, CPI. And the interest payments are then calculated on this adjusted principal. This mechanism ensures that the bond's purchasing power is preserved, making them an ideal choice for investors concerned about inflation. Other fixed income options like traditional treasury bonds, CDs, and municipal bonds have fixed principal and interest, making them vulnerable to inflation risk. Question 18. A customer buys 100 shares of ABC stock at $50 per share and simultaneously buys one ABC 50 put option at a premium of $3. What is the investor's maximum potential gain? A. Unlimited. B. $500. C. $300. D. $4,700. Answer A. Unlimited. This strategy is known as a protective put. The investor owns the stock and buys a put option to protect against a decline in the stock's price. While the put limits the downside risk, the investor still retains the full upside potential of owning the stock. If the stock's price increases significantly above $50, the put option would likely expire worthless, resulting in the loss of the $300 premium. But the gain from the stock's appreciation would be unlimited. The maximum gain is the difference between the stock's market price and the purchase price, less the premium paid for the put. Question 19. An investor sells 100 shares of XYZ stock short at $40 and writes one XYZ40 put option at a premium of $4. What is the maximum loss on this position? A. Unlimited. B. $400. C. $3,600. D. $4,000. Answer A. Unlimited. This strategy combines a short sale with writing a put option, resulting in what's known as a short stock/short put position. When an investor sells a stock short, they are obligated to buy it back in the future, and their potential loss is unlimited if the stock price rises significantly. Simultaneously, writing a put option obligates the seller to buy the stock at the strike price if the put is exercised. If the stock price increases substantially, the short stock position has unlimited loss potential, and the premium received from the put will only partially offset this loss. Question 20. Which of the following events would cause the net asset value, NAV, of a mutual fund to decrease? A. The fund receives dividend payments from its portfolio stocks. B. The value of the securities in the fund's portfolio increases. C. The fund distributes dividends to its shareholders. D. New investors purchase shares of the fund. Answer C. The fund distributes dividends to its shareholders. The net asset value, NAV, of a mutual fund is calculated by subtracting the fund's liabilities from its total assets and dividing by the number of outstanding shares. When a mutual fund distributes dividends or capital gains to its shareholders, the fund's assets decrease by the amount of the distribution, which directly causes the NAV per share to decrease by the same amount. Conversely, the fund receiving dividend payments, an increase in portfolio value, or new share purchases would all tend to increase or have no impact on the NAV per share immediately, as assets and shares outstanding increase proportionally. Question 21. A customer establishes an account with their spouse as joint tenants with right of survivorship, JTWROs. If one spouse dies, what happens to the assets in the account? A. The assets are distributed according to the deceased spouse's will. B. The assets are frozen until probate court determines ownership. C. The deceased spouse's interest passes automatically to the surviving spouse. D. The assets are divided equally between the surviving spouse and the deceased spouse's estate. Answer C. The deceased spouse's interest passes automatically to the surviving spouse. Joint tenants with right of survivorship, JTWRS, is a common form of joint ownership where each tenant owns an undivided interest in the entire account. The key feature of JTWRS is the right of survivorship, which means that upon the death of one joint tenant, their ownership interest automatically passes directly to the surviving joint tenant by passing probate. This ensures a smooth transfer of assets and is often used by married couples for convenience and to avoid the probate process. Question 22. Under the Bank Secrecy Act, which of the following is considered a suspicious activity that would likely require a broker-dealer to file a suspicious activity report, SAR? A. A client withdrawing $5,000 in cash from their account. B. A client making frequent small deposits into multiple accounts. C. A client regularly receiving dividends from their investment portfolio. D. A client consistently declining to provide source of funds for large transactions. Answer: D. A client consistently declining to provide source of funds for large transactions. The Bank Secrecy Act, BSA, requires financial institutions, including broker-dealers, to report suspicious activities to prevent money laundering and terrorist financing. While a client making withdrawals or receiving dividends is normal, consistently declining to provide the source of funds for large transactions is a significant red flag. This behavior suggests an attempt to conceal the origin of money, which is a hallmark of money laundering, and would necessitate filing a suspicious activity report, SAR, with FINCEN. Broker-dealers must be vigilant in identifying and reporting such patterns. Question 23. A syndicate member in an equity IPO agrees to act as a selling group member. This means the member: A. Has no financial responsibility for unsold shares. B. Is committed to buying a portion of the shares from the issuer. C. Can directly set the public offering price. D. Is responsible for conducting due diligence on the issuer. Answer: A. Has no financial responsibility for unsold shares. In an underwriting syndicate for an equity IPO, a selling group member acts as an agent and helps distribute the securities but assumes no financial responsibility for any unsold shares. They simply sell the securities on behalf of the syndicate, earning a selling concession for the shares they place. In contrast, an underwriter, or syndicate member acting as such, commits to buying a portion of the shares from the issuer and bears the risk of unsold shares in a firm commitment underwriting. This distinction means less risk for selling group members compared to syndicate members. Question 24. An investor purchases a 5% corporate bond at a premium. Which of the following statements about its yields is true? A. The current yield will be higher than the nominal yield. B. The yield to maturity will be higher than the nominal yield. C. The nominal yield will be higher than the current yield and yield to maturity. D. The yield to maturity will be lower than the nominal yield and current yield. Answer: D. The yield to maturity will be lower than the nominal yield and current yield. When a bond is trading at a premium, above its par value, its yields follow a specific inverse relationship. The nominal yield, coupon rate, is the stated interest rate and remains fixed. However, because the investor paid more than par, both the current yield, annual interest divided by current market price, and the yield to maturity, reflecting the total return if held to maturity, including the capital loss from the premium, will be lower than the nominal yield. Specifically, for a premium bond, the order of yields from highest to lowest is nominal yield greater than current yield greater than yield to maturity. Question 25. Which of the following is considered a lagging economic indicator? A. Average weekly hours, manufacturing. B. Building permits. C. Corporate profits. D. Manufacturers' new orders for consumer goods. Answer: C. Corporate profits. Lagging economic indicators are economic factors that change after the economy has already begun to follow a particular pattern or trend. They are used to confirm or explain past economic performance. Corporate profits typically reflect business conditions that have already occurred, rather than predicting future economic activity, thus making them a lagging indicator. In contrast, average weekly hours, building permits, and manufacturers' new orders for consumer goods are examples of leading indicators, which tend to change before the economy does, helping to forecast future economic trends.